Hello friends, welcome to our channel. We're thrilled to have you here with us today. Today, we're going to dive into the fascinating world of the stock market. It might seem a bit scary at first, like a big confusing place, especially if you're new to all this. But trust me, it's not as intimidating as it looks. But don't worry, it's not rocket science. With a little bit of knowledge, you'll be navigating it like a pro in no time. Just imagine a massive market where people buy and sell small pieces of big companies. These pieces are called stocks. When you buy a stock, you become a tiny owner of that company. It's like owning a small slice of a big pie. The more stocks you own, the bigger your slice of the pie. And with that ownership comes certain rights and potential profits. The stock market is super important for the world's economy. It helps companies get money to grow, and it helps people like us invest and grow our savings. It helps companies get money to grow, and it helps people like us invest and grow our savings. It's a win-win for everyone involved. Prices go up and down depending on how many people want to buy or sell, what's happening in the news, and how everyone's feeling about the market. It's a dynamic and ever-changing environment. Understanding how the stock market works is important for anyone who wants to invest wisely. Knowledge is power, and in this case, it can also be profitable. So whether you're a pro or just starting out, knowing the basics can help you make smart decisions and maybe even earn some good returns. It's all about making informed choices. So let's get started and explore this exciting world of stocks together. There's so much to learn and discover. The stock market has a few important parts that make it all work. Think of stock exchanges like big shops, online or real, where stocks are bought and sold. You might have heard of some famous ones like the New York Stock Exchange, Nasdaq, and the London Stock Exchange. These exchanges make sure everything is fair and follows the rules. Then there are brokers. They're like helpers who buy and sell stocks for you. They connect you to the stock exchanges and take a small fee for their service. The government also keeps a close watch on the stock market to protect investors and make sure everything is above board. Agencies like the Securities and Exchange Commission in the US make sure everyone follows the rules and nobody cheats. Now, let's talk about the main thing, stocks. Stocks are a fundamental part of the financial world, and understanding them can open up many opportunities. A stock, also called a share, is like a tiny piece of a company that you can own. Think of it as owning a small slice of a big pie. When you buy a stock, you become a shareholder, which means you own a part of that company and its profits. This ownership can give you a say in how the company is run. Companies sell stocks to raise money for different things like expanding their business, doing research, or paying off loans. This process helps them grow and innovate. The price of a stock goes up when more people want to buy it than sell it, and it goes down when more people want to sell. This fluctuation is driven by market demand and investor sentiment. One cool thing about owning stocks is you might get dividends. Dividends are a way for companies to share their success with their shareholders. Dividends are like bonus payments that companies give to their shareholders from their profits, usually every 3 months. It's a reward for your investment in the company. Not all companies give dividends, but some do. And it's like getting a little extra income from your investment. This can be a great way to build wealth over time. Understanding stocks and dividends is really important for making smart choices in the stock market. With this knowledge, you can make informed decisions and potentially grow your wealth. So, how do you actually buy and sell stocks? It's easier than ever these days thanks to the internet. You can open an account with a broker online, put in some money, and start buying and selling stocks right from your computer or phone. When you want to buy or sell, your broker does the work for you, finding someone who wants to sell or buy the same stock. There are different ways to buy and sell. A market order buys or sells immediately at the best price available. A limit order lets you set a specific price you want to buy or sell at. A stop-loss order helps you limit your losses by automatically selling if the price drops too much. Knowing these different ways to buy and sell and having a plan can help you manage your risk and maybe even make better trades. Section 5. Different kinds of stocks. All stocks are not the same. There are many types, each with its own features and risks. The two main types are common stocks and preferred stocks. Common stocks are the most common type. They give you voting rights in the company and a chance to get dividends. Preferred stocks usually don't give you voting rights, but you get a bigger share of the company's assets and dividends if things go south. Stocks can also be grouped by their size, the industry they're in, and how fast they're growing. Large cap stocks are from big, well-known companies. Small cap stocks are from smaller, newer companies. They can grow faster, but they're also riskier. Knowing about different types of stocks can help you spread your investments and choose stocks that match your goals and how much risk you're comfortable with. Section 6. Understanding market indexes. Market indexes are like scorecards for the stock market. They tell you how well a particular market or group of stocks is doing overall. They track a bunch of stocks together, kind of like a team. The S&P 500 is a famous index that tracks 500 big US companies. It shows how about 80% of the US stock market is doing. Other popular indexes are the Dow Jones Industrial Average, DJIA, which tracks 30 big US companies, and the Nasdaq Composite, which focuses on tech companies. Investors use market indexes to see how their own investments are doing compared to the overall market. Market indexes can also track specific industries like healthcare or energy. Understanding these indexes gives you valuable information about market trends and helps you make smarter investment choices. Section 7. Introduction to cryptocurrency. Let's talk about cryptocurrency, which is like digital money. It's become really popular in recent years. Unlike regular money issued by governments, cryptocurrencies work on a network of computers using something called blockchain technology. Blockchain is like a digital record book that keeps track of all transactions, making it very secure and transparent. Bitcoin, created in 2009, was the first cryptocurrency and is still the most famous. Since then, many other cryptocurrencies called altcoins have come up, each with its own special features. Some popular ones are Ethereum and Dogecoin. Cryptocurrencies can be used to buy things, store value, and even as tokens in special apps. But remember, cryptocurrencies are still new, and their prices can change a lot very quickly. Section 8. Stock market versus cryptocurrency. A detailed comparison. Both the stock market and cryptocurrency offer ways to invest, but they are very different. Each has its own unique characteristics, benefits, and risks that appeal to different types of investors. Stocks represent ownership in companies, giving shareholders a stake in the company's success, while cryptocurrencies are digital assets based on blockchain technology, offering a decentralized form of value. The stock market is closely watched and regulated by government agencies to ensure fair trading practices, while cryptocurrencies are mostly unregulated, leading to a more volatile and unpredictable market. Stock prices depend on how well the company is doing, including its earnings and growth potential. In contrast, cryptocurrency prices depend on the underlying technology, the number of users, market demand, and overall sentiment. Stocks can give you ownership rights and dividends, which are regular payments made to shareholders from the company's profits. Cryptocurrencies, on the other hand, give you digital tokens that can be used for transactions or held as an investment. Stocks are generally less volatile than cryptocurrencies, meaning their prices don't change as drastically or as frequently. This makes stocks a more stable investment option for those who prefer lower risk. Stocks are usually traded during specific hours on weekdays, known as market hours. In contrast, cryptocurrencies are traded 24/7, allowing for continuous trading and price fluctuations at any time of day or night. Stocks are generally easy to buy or sell through established brokerage firms, while some cryptocurrencies can be hard to trade due to limited availability on exchanges or complex transaction processes. People invest in stocks for long-term growth and dividends, aiming to build wealth over time. On the other hand, people invest in cryptocurrencies for quick profits, speculative gains, and to be part of the new world of decentralized finance. Stocks have moderate to high risk, depending on the company and market conditions, while cryptocurrencies are considered very high risk due to their extreme volatility and lack of regulation. In short, stocks are more established, regulated, and less risky, making them a good choice for long-term investors who seek stability and steady returns. Cryptocurrencies are newer, less regulated, and very risky, appealing to those who can handle big risks and are excited about investing in innovative technologies and the future of digital finance. Section 9. Conclusion. Important tips for investors. The stock market and cryptocurrency offer different investment opportunities, each with its own risks and rewards. Stocks are a more traditional way to invest in established companies, while cryptocurrencies are a newer, more volatile, and potentially high-growth area based on blockchain technology. Before investing in either, do your research, understand the risks, and think about your goals, how long you want to invest for, and how much risk you can take. It's a good idea to spread your investments across different things like stocks, bonds, and maybe a little bit of cryptocurrency if you're comfortable with the risk. Remember, investing is a long-term game. Patience, discipline, and a long-term view are important for navigating the market's ups and downs and reaching your financial goals.